How are things now? My name is Paddy, and welcome to the 11th episode of my podcast, Finding Cashflow. So, on this, my 11th episode, I'm going to try and do this a little differently to the 10 episodes that I've done before now, because looking back on the first 10 episodes, they're quite long. They're about half an hour, and many people would say they're extremely well drawn out. In fact, I wouldn't at all expect anybody to sit through it, in all honesty. And from listening through them, I speak in a very monotone and a very kind of boring voice. And now that I'm hearing myself out loud again, I seem to have failed to rectify that. But they also seem a little bit rehearsed. And I almost feel like that had to be the case with my first 10 episodes, because in the first 10 episodes, I wanted to be very clear on the concerns I had regarding our Canadian and our global economy. And those episodes were extremely, fact heavy and data heavy. And we shared a lot of graphs. So it was almost hard to make them exciting or entertaining, essentially. But I was covering topics that I focus on quite a lot, such as the negative cash flow that these new pre-construction apartments are going to be experiencing upon closing, as well as predictions such as the prediction that here in Canada we're going to break our record for new home supply in 2025, which is the year that has just gone. And even though that year is now behind us, we don't know if that's true yet or not. In fact, that won't become official data for quite a while. But this is something I believed would happen quite a few years now, because even back in 2022, when the only narrative that was out there was that we simply couldn't build homes quickly enough in Canada, the data was showing us that we were already building far more homes than we ever were before. We then looked at the record population decline that we're now experiencing in Canada, and it wouldn't be very hard for it to be a record population decline, because we've hardly ever experienced a population decline in Canada here in recent history. We then went on and we looked at G7 government debt, and we looked at the deficits as well as the bond yields of the G7 nations, such as UK and France and Germany. And we paid a lot of attention on the US fiscal situation in particular, and particularly that of the US government. And we looked how the US government is now spending 40% more than what it brings in each year. We then looked at the debt levels in Japan, and particularly we looked at Japanese bond yields, and they've massively spiked now in recent weeks again, at an alarming pace, essentially, I would have to say. And I believe that this was caused a real problem for something known as the yin carry trade. And I'll dedicate the entire next episode to the yin carry trade, because that in itself is a very important topic, and it's extremely important even when we're looking at our entire global macroeconomic situation. There's other things such as private equity and private credit that I want to look into as well. But for this episode, I want to revisit something that we looked at last year in episode 3, and known as the CAPE ratio. The CAPE ratio essentially is a price to earnings ratio, and we looked at the price to earnings ratio of the S&P 500 in particular, and we very quickly saw that the S&P 500 is at its second highest valuation of all time in accordance with the CAPE ratio. We then went on to look at past periods in time in which the valuation of the S&P 500 was also at these very elevated levels. And the third highest valuation of all time was at the end of the 1920s, at the end of the Roaring Twenties. And this was a point in time in which we very much found ourselves in an equity bubble that then ended up popping. And this is how the US and then the globe sank into the Great Depression. The highest valuation of all times was at the end of the 1990s, at the end of the dot-com boom, which then became a dot-com bubble, which then became a dot-com bust. In fact, it's new technologies that are the consistent theme when we look across all these times in which equity markets, and specifically the S&P 500, was extremely highly valued. If we go back to the 1700s, the new technology that we had then that really stands out was the invention of the canals. The invention of the canals really revolutionized how economies in the world transported goods and services around their countries. And in the UK in particular, where the canals were extremely popular, this led to an equity bubble that again ended up popping. Then in the Industrial Revolution in the 1800s, we had the invention of the train. And I know AI is huge and it'll continue to be huge, but imagine going from horses and carts to transport goods and services to now going to a train and carriages and a track. This enabled us to essentially have our industrial revolution in a point in time in which our economy grew massively. But once again, the invention of the train in the short term led to an equity bubble, which ended up popping. Then we had the automobile in the 1920s, and the automobile once again really revolutionized the way that we could transport goods and services around our economy. Now that we didn't need a canal anymore and we didn't need tracks anymore. Now we could drive anywhere where there was a road, and this was a huge advancement for the US and for our global economy. We had other technologies in the 1920s as well, such as the radio. And imagine being a business owner back in the 1920s and finding out that you can advertise your goods and services in houses around your larger area or across your entire state with your own voice without ever stepping into those houses. It was once again truly revolutionary. And then in the 1990s, we did the invention of the internet, and all companies today still use the internet, just like they still use the car, just like they still use the train, and many still use the radio. So these technologies completely revolutionized how our companies sell goods and services, and we never went back to the way we used to do things. These technologies changed our economies in irreversible ways. And today we have AI, which is once again a massive new technology. And what it has once again caused is it has caused investors who see this new technology and how substantial this new technology is. And I believe that these investors have once again got overly optimistic about the future earnings expectations of these companies. That's why we now have market analysts that say that the market is now priced per perfection. Essentially, what they mean is that we are expecting these companies to experience massive growth in their earnings over the next few years. And not are we only hoping that this will happen, we are actually betting on the fact that this will happen. And we're betting on the fact that this will happen by buying up these companies and driving the valuation and the price of these companies extremely high, and then continuing to buy these companies at these very high prices. So if these companies don't realize these massive gains in earnings, then what that will mean is that the price of these companies will prove to be too high, and that may cause a correction. To explain the concept of being priced to perfection, I view it the same as us going into an exam. And let's just assume that we're going to an exam in a subject that we're very competent in, and we'd be very confident that we would pass this exam. If we needed a 40% or a 50% or 60% grade to pass this exam, we'd be quite confident that we could achieve that. But let's say now that because we are priced to perfection, that's like going to an exam where we have to get 90% or 95% correct in order to pass the exam. Now we might be a bit more worried because there's very little room for things to go wrong. And if we look at things that can go wrong in our global economy right now, I'm recording this episode on January 28th, and today in particular is a day of huge geopolitical unrest. And we can really see that in the gold price being driven higher right now. I checked gold a while ago, which is up 8% today alone, and I've been invested in gold for a while now, and I've never seen a daily move in gold such as today's. And gold has been driven by this geopolitical risk. Trump has sent an armada of ships that are now sitting off the coast of Iran, and Trump has been on the news today saying that he may strike Iran, and that's essentially what's driving gold higher. But I really try and not focus on the day-to-day or the week-to-week noise that we're constantly being bombarded with on the news right now, because Trump may say that he's going to fire on Iran today, and next week he might say that he's got a deal with Iran and he's got a fantastic relationship with Iran, and 2 or 3 months from now that deal may be off again. So I try not to get caught up in the daily and weekly noise that we're constantly being bombarded with, and I certainly don't change my portfolio on a regular basis based on all this noise. When I'm investing, I always invest with a 12 to 18 month or 24-month time horizon. And based on that, regardless of what happens tomorrow or next week or next month, I have to think that our global economy is becoming further separated from each other. The US has essentially chosen to not just distance itself from its enemies, but it's also distancing itself from its friends. And it started off doing this about a year ago by instigating this trade war, where they're essentially trying to buy less goods and services, mainly goods from the rest of the world. But what I think they're not fully understanding is that a lot of these countries, even China, that were selling a lot of these goods to the US, when the US was then paying these countries for these goods with US dollars, these countries were then buying US treasuries. So essentially what these countries were doing was loaning those dollars right back to America, buying their US treasuries, and essentially financing their government spending and their massive government debt. And now we can see these countries moving away from buying US treasuries and they're buying gold instead. And that's why gold has been on an increase now for over 2 years, because it's the central banks that have been buying gold. And I was a lot happier investing in gold up until 6 months ago when nobody was talking about gold. And the only people I knew that were buying gold, other than myself, were the central banks. And these central banks around the world aren't buying gold to make a profit quickly or to sell it again quickly or to trade it. They're buying gold and putting it in vaults deep underground, which is why I believe there's a solid foundation under the price of gold. Although we have seen a lot more buying from ETFs recently. And I think this will make the price more volatile because the retail investor is now getting involved and they may quickly sell it again. But the main buyer of gold, I believe, will still continue to be the central banks, which is why I continue to be very bullish on gold and will continue to leave the majority of my portfolio in gold. And I don't want to become too alarmist now and focus too much on the geopolitical risk that we're seeing today and this week and last week. Instead, I want to look at a longer time horizon and look at the bigger picture. And essentially, I was already very worried about these equity markets even before any of this geopolitical risk started propping up. As an example, in the episode that I released last summer, where I did a lengthy episode on all the things that I am worried about with regards to the valuation of the S&P 500, geopolitical risk is something that didn't come up at all. And I'm not going to go over all the things I spoke about in that episode because that's where I would get back to being very data and fact heavy and showing a lot of charts and all the rest of it. And once again, I'm trying to make this episode a lot less boring. And perhaps the reason the episodes were boring is why a lot of people weren't really looking at my episodes over the past 10 episodes. But in all honesty as well, I wasn't trying to promote them very much. I wasn't setting up an X account or an Instagram account or a Facebook account and sending out these short videos to everybody hoping that they'd view my channel. I almost didn't want to become popular, not that I would ever become a popular voice or anything near it, but I almost didn't want, I took no pride in getting the message out about something that I was essentially quite negative about. So this podcast hasn't been very, very popular, I don't think, up until now. And for that reason, I think the majority of people who are looking at it are family and friends. And on that note, I hope that you're all keeping well, and I can't wait to see you all again very soon. But that comes back to the main reason that I started this podcast is because, first of all, I felt I had information that I wanted to get out there. And this information led me to be quite worried about our global economy, as well as our local economy, our Canadian economy, as well as the US economy, which we're all dependent on. And I wanted to talk about those worries. And in particular, I wanted to tell my friends and family about these worries, because right now, we as a collective economy, we're far more invested in the stock market than we ever have before. People out there have far more invested in stocks than what they might even realize themselves. There are a lot of people out there who've been building their pension over a long period of time, and without even knowing it, a lot of their pension may be invested in the likes of Nvidia and Tesla and these other companies that have just seen huge run-ups over the last few years. I was even a little bit, quite worried about my girlfriend's portfolio a year ago. My girlfriend had a lot of equities, which she was very proud of. She'd built them up over a period of time, and I too, not so long ago, was invested in equities. But from talking to my girlfriend a lot, she now too is positioned with the majority of her portfolio in physical gold, and that's something that I was very happy with when she started doing that. And in recent times, we're both very happy with that, because essentially gold has done better in the last 6 months than the S&P 500 has ever done in a 12-month period. And I also want to kind of fix some misconceptions that are out there. People think that, first of all, they think that it might be difficult to understand what your portfolio is invested in. And even if we know it is invested in, people might feel like it would be very hard to switch it or to change it. And that's completely untrue. When I moved the last of my portfolio away from equities, essentially it was over a year ago. I was lying in bed staring at the ceiling at nighttime, and when it became evident that Trump was going to become president of the US, I decided to move completely away from equities. And I hopped out of bed one night and I went on my laptop here, logged on to my Manulife, and I moved the last of equities that I had in my Manulife RRSP as well as my DPSP. And I moved that money out of equities, and I was back in bed within about 15 minutes of having jumped out of it. I'd also like to say that I commonly don't lose much sleep because of how I'm invested. And that's very important as well, because we invest to enhance the quality of our life. And if you're invested in such a way that you're losing sleep, then that already would be suggesting that you may need to look at how you're invested and look at how exposed you are to risk. So it's very possible to know how you're invested, and it's quite easy, a lot easier than a lot of people think, to change how your portfolio is positioned. But one thing that hasn't at all been easy over the last few years, I've come to find, is it isn't at all easy, and in many, many cases, it's completely impossible. It has proven to me to be impossible to have a conversation with someone who is very bullish on equities, meaning someone who believes that the stock market would only go up. And what I'm saying is difficult is not the conversation. The conversation itself is not difficult, but what it's difficult is to change anybody's opinion. Oftentimes when I have these conversations, both of us would go our separate ways with the same opinions that we had coming into the conversation. Me being worried about the global economy as well as our local economies of Canada and our neighbour's economy, the US, and being very happy to be positioned in gold. And for the most part, the other people would walk away being very happy that they are still positioned in equities and very excited about the future earnings potential of these companies. And because it's hard to change people's opinion, I'm not even sure am I trying to change people's opinion. All I really am hoping is that we talk about this more, and it's good to have conversations about these things. And one entity that it's very useful to have a conversation with in particular is ChatGPT. This is something we can have very quick and easy and very educational conversations with now. And I guess what I'd ask people to do is, even if you were to open up ChatGPT on your phone, and just be aware of how highly priced and valued these equity markets are. Ask ChatGPT how highly priced these equity markets are. Ask it, what were the periods in time in which equity markets were also very highly valued? Then go on to ask it, what were the similarities between today and these past periods of time? And then go on to have detailed conversations with it about how these past periods in time ended. Because from reading history, and I've many books behind me, including a book that's standing up here, which is about the history of gold, is the start of the book. But essentially what it's about is the history of money, because gold has been money for about 2,500 years. And when I read history and read these stories, I start to get the impression that history does repeat. And from reading these stories, a lot of what I'm reading sounds very similar to what we're living through today, particularly around the new technology part of these stories. And from reading how these other stories ended, I'm quite concerned that we might see a similar ending to the story that we're living through today. So hopefully this new format of this podcast is more enjoyable to listen to. It's absolutely something you can listen to as you're driving in the car, as opposed to the other 10 podcasts, which I've been recommending that my friends actually have a sit down and look at the graphs and really try and look at the data that's been shown. But now I'm trying to make podcasts that are easier to listen to, and I hope this one was. And my next podcast will be on the yen carry trade. So if you'd like to hear and know about the yen carry trade, please hit like and subscribe. And we'll see you all again soon, hopefully.